Mike Swanson here. This is Module 1 in a course designed to help you learn how to invest and trade gold to make some nice profits in the coming years. Module 1 is titled The Power of Gold. It's about how to understand gold as an investment class. And that's what we got to do first before we get deeper into this topic. But first of all, there's two giant myths out there that if you're familiar with CNBC, you're just looking at lots of mainstream financial websites that are drilled into people's heads. It's why most people don't even own gold, which is really crazy, as you'll see by the end of this video. But they're told, do not buy gold because it pays no dividends. And the supposition is an investment's only good if you can get dividends from it. Well, most people are buying stocks that pay no dividends to start with, but I'm going to show you anyway in a follow-up video in another module how you can actually get income from owning gold. So that argument's a bunch of baloney. The other argument out there that people say is that there's nowhere you can put your money into but the U.S. stock market. So the only thing you can do is put your money into the U.S. stock market and just pray it will go up for you. Well, that's a bunch of nonsense, as you'll see in this module right here. Let's talk about the Dow, though, that makes people think that that's true. Here's the Dow going back to 1996. As I'm speaking on March the 30th, doing this video, it's at 17,716. That's where it closed at back in 1996. Below 5,000. So that's a return of approximately what? A little less than 4 to 1 from 1996. That's a long time. Now, I got into the markets in the mid-90s. The Dow was much higher then. It was around 9,000 or something. But the key is around 1999-2000, things really started to change for the U.S. economy, for the financial markets. We had a nasty bear market, then we had a bubble run up until 2007, and then associated with the real estate boom, that all collapsed. But then we came back with the Fed lowering rates to zero and doing money printing operations over the year, but momentum has stalled on that move. But the thing is, since the year 2000, the Dow's gone from 11,000 to 17,000. Let's just say a nice 70% return. Of course, more meaningful for people's investments is not the Dow to look at to understand the market, but the S&P 500. In that case, the S&P 500 has gone from, let's say, around 1,400 the year 2000 up to 2,000, 2,063 to be exact. That's a nice return. But even if you go back to 1996, we were around 600. So you're talking about a 3 to 1 gain, let's say, if you held through all these horrible drops. And that's a big problem with the notion that only thing you can do is put all your money in the U.S. stock market, because if you do that, one day there's going to be another decline. It could start much sooner than people even expect. And when it does, you know, people in the U.S. stock market could lose half their investment. You don't want to do that. We'll talk about how to escape that trap of bear markets in a moment. But the point I want to make first is that the gains in gold are actually bigger than the gains of the stock market. Gold made a bottom around 1999, around $250 an ounce, and it went up to $1,900 an ounce in 2011. It's a much bigger run during those years than we saw in the Dow, than we saw in the S&P 500. Now, granted, since 2011, there was a bear market in gold, which made it go down from around 1,900 to around, let's say, 1,050. It's a big loss, but things are looking back up, as we'll go into more detail later why the picture is much better for gold. But the important thing is, even with the gold now sitting at 1,225, it's still been a bigger gainer than you would have experienced if you plopped all your money into the Dow. or the S&P 500 for that matter, and the NASDAQ. So the idea that the stock market is the only thing you can make money in is a giant myth. The idea that you should not own gold, which is what they tell you on TV, is a giant myth too. The reason why they tell you that is because the only thing they want you to do, if you're an American investor and you're watching the financial media in the United States, is own the U.S. stock market, because it's just the consensus, it's just the brainwashing of Wall Street. And Wall Street brokers make much more money when you have your money invested in mutual funds. They're getting trails and on and on and on. It's a whole other topic. But you can see the gains for gold can be big. Not only that, when gold has a bull market, it goes up huge, as you can see from, let's say, 2002 up to 2011. And there are big gains like that in the 1970s, and I think big gains like that are ahead of us. But let's step aside from gold for a second. Everybody knows that diversification is a key long-term investment strategy. People think of diversification as a way to limit your risks to any one market falling and causing you a lot of hardships. That's true, but diversification does more than that, as you'll learn throughout. If diversification is done properly, that's the key. And I'll show you how to do that. It actually can boost your long-term investment returns, as you'll learn. It's a key concept. But regardless, the one thing you need to realize is gold is an asset class, just like stocks are an asset class, just like bonds are an asset class, just like currencies are an asset class. And real diversification means being invested in multiple asset classes. Therefore, gold plays a key role in owning and holding and participating in a very well diversified portfolio. And real diversification means more than just not having all eggs in one basket, as you'll see. But one thing that makes gold work from a diversification standpoint and help you boost your long-term investment returns is owning gold is so important, because it does not trade with the U.S. stock market. Okay, look at this chart of gold. Below, I've added an indicator. It's taking the price of gold, dividing it by the S&P 500, and looking at the 200-day moving average of these prices, the average price over 200 days. And it's looking at how what this is doing for us is showing us how closely correlated that matrix is. It's a correlation indicator. I'm using the website stockcharts.com. When that indicator you see is at 1, it means that what I'm studying is perfectly correlated with the other thing I'm comparing it to. So in this case, I'm comparing gold with S&P 500. If that was at 1 and was flatlining like this, that would mean they were trading lock, stock, and barrel together. If they're at -1 all the way down to the bottom of that line, that would mean they're trading opposite together completely. So say the S&P 500 went up 1%. Tomorrow gold would go down 1%. If they were negatively correlated, -1, perfectly negatively correlated. 1 means it's not correlated together positively or negatively, that they kind of just trade in their own world, separate from each other. And that's really what's a good thing to have. You want a portfolio that is in a mix of asset classes, a mix of funds that together have a low correlation together. And again, that's a concept we'll go into more detail. But the key is that gold has a negative 0.2 correlation with the stock market. So that tells us that gold doesn't trade with the stock market. Gold can be going up and the stock market's going down. Gold is an own world of itself. You don't have to worry about what the stock market's doing when you own gold or vice versa. So therefore, gold is a great thing to own, especially in times when the stock market's weak, especially in times when the stock market's in a bear market, especially in a time when there's a major financial or debt crisis. People know that, and they think, well, great, gold is a wonderful insurance. What the point of this video, though, is to tell you it's more than that. Gold is a way to make money, not just have insurance, because gold goes up in the long run. And gold goes up when the stock market, gold goes up without having to have the stock market go up too. Now let's look at treasury bonds for a second. Step back and understand this correlation relationship a little bit more. Treasury bonds, the typical American investor has said, okay, we want you diversified. What you're going to do, you're going to buy stocks, you're going to buy bonds, that's it. That's all you got to do. And the reason they tell people to do that is because Treasury bonds are strongly negatively correlated with the stock market. They tend to go up when the stock market goes down. At least that's what they've done historically. And as a result, I have TLT, an ETF that tracks the 20-year Treasury bond on this chart. On the bottom is the correlation indicator showing us how it trades with SPY, an ETF that tracks the S&P 500. As you can see, as right now is a negative 0.5 correlation. Usually when it does, kind of a freak thing, become closely correlated to the stock market, it's a temporary situation. But here's the problem with bonds. They have gone up so much and interest rates are zero that there isn't much upside to them because bonds trade opposite to interest rates. So when interest rates go up, bonds fall. And they're at like a secular all-time peak. So they have very limited upside. So that makes them like, the only reason to own bonds isn't really to think you're going to make money from them, but just as a pure safety play in case the stock market goes into some sort of sudden collapse. Well, I like to own things not just for insurance, but because I think they're going to go up for several years, and we cannot say that about bonds. But I just want to, that's why I don't think bonds by themselves, I don't own bonds, okay? I'll just say it flat out, I do not own bonds. But put that to the side, I don't think simply owning bonds and stocks at this point in time is a good way to be diversified, even though that's what most people do, even though that has been a good way for decades. From now on, I do not think so. I think you have to do more than that, and that's where gold plays a key role now in everybody's portfolio, I believe, should own gold. But let's look at gold and TLT. They actually have traded a little bit together over the years, more closely than they have with the stock market. They trade more closely with one another than they do with the S&P 500, and that's why gold and TLT have a correlation of 0.53. It's slightly positive. It's not 1. They don't trade lock, stock, and barrel together, but the reason this has happened is because there have been times of crises in which they have had temporary moves up and so forth. So that's just the relationship. I wanted to point that out to you, and also to show you that you can study these correlation relationships of all kinds of markets, all kinds of exchange traded funds, and see what's going on. And I don't think anyone should own everything in their portfolio that's all trading together. You want to be spread out, and you can find out if you are or not by doing this type of analysis using stockcharts.com. I'll show you other tools to do this later. We'll get deeper into that thing. But let's just talk about the hypothetical portfolio for a second. Let's say you're invested in SPY, an ETF that tracks S&P 500. You're invested in TLT. And a lot of people also have a core position in cash. That's really what the typical thing is. Let's have stocks, bonds, cash. Well, let's add gold to that, okay? Now, there is still a danger of a debt doomsday risk that could impact the stock market, the financial markets. Maybe the European markets will dump. Maybe China will dump. Maybe the United States will have a bond blow up in the treasury market because of the government debt or the corporate debt situation. Who knows? There is that danger. The Congressional Budget Office, in fact, says by 2030, the stuff's going to hit the fan unless the budget is cut, the budget deficit's reduced. So that's out there. So let's think about what would happen to a hypothetical portfolio in that situation. Well, let's look at U.S. dollars too. Here's the purchasing power of the U.S. dollar. And as you can see, it has shrunk like crazy. It started at $100, let's say, back in 1900. Today, $100 back in 1900 is worth $3.48. And the Federal Reserve is printing money all the time. If the stock market were to decline, they'd print more money. The key, though, is that the value of the U.S. dollar is continuing to decline because it's a paper currency. Because of that fact, I don't have dollars right now as a core position in my portfolio. I don't have any in my portfolio. Only time I got dollars is when I want to sell stuff and just step back, or it's just rare times and it's a temporary situation. So I don't believe people should own a core position in an asset that is truly going to lose value over time, because that's what it's done all the time, because it's a paper currency. The nature of paper currencies are to lose their value, especially when they're printed by central banks endlessly. So I don't believe in a core dollar position. It's not safety, okay? It's not safety to have 10% of your portfolio in cash, or 100%, or stuff your money in a mattress, when that's going to lose value every day. It's like saying, I'm going to invest in used cars and just park them outside and drive around every day in them and let the mileage pile up, and that's an investment. It's not. It loses value just like cash does. That's why gold is something to have in a portfolio. I think gold should replace people who have cash in their portfolio just because of this. But let's look at the U.S. dollar index, because right now people aren't thinking about the dollar as something they don't want to own, because from 2014 to really the end of 2015, the dollar index went from 80 to 100. The U.S. dollar index measures the U.S. dollar versus a basket of global currencies. As you can see, back in 2000, it went from 120 to below 75, a big tumble. Gold, of course, had a massive run during those times. And I think the U.S. dollar index has probably topped out here, and we can easily see it go into a bear market this year, which would be a reason to think gold can go up. So the point is that, the U.S. dollar index is not something that has gone up year over year after time. What I'm showing you right here from really 2008 to 2016 is one of the best runs in the U.S. dollar index ever. And there was a run before that in the 1990s, and it led to a massive bear market, and it's never really recovered from those highs ever since, and it probably never will because of inflation, because dollars are printed every single day. So this is a horrible investment for people to own. But more importantly, gold is negatively correlated to the U.S. dollar by a factor of 0.56. In fact, you can almost never find a situation in which gold is positively correlated to the U.S. dollar by 0.75 or better. This is a good thing, because what it means is essentially that because over time the U.S. dollar is being printed and there's inflation over time, and because because that means the U.S. dollar is going to lose value over time, and because gold's negatively correlated to it, just that fact alone means gold is a good investment to own in a portfolio, because it's going to go up in value against the U.S. dollar, because the dollar is a depreciating asset. So once again, that's a reason to eliminate cash as a core position, replace it with gold at the very least, the concept I want you to think about. But look, all that said, I do not look to make money with this notion that I want insurance. I look to make real money by owning things that are going up in value. I don't think I'm going to own my gold for an insurance policy in case the financial markets blow up, or because I watched some other video where some guy's talking about Armageddon or the end of the world or the sky is falling. No, gold, as I've shown you from these previous slides, goes up in value against the U.S. dollar, and it's gone up better over the years, more over the years, even in the stock market. So gold's a great investment in itself, and that means it can make us money, and that's by itself is a reason to own it. But anyway, that chart you see right there, that's the stage analysis system I use to figure out whether a market is in a bull market, a topping market, a bear market, or stage 1 base. I don't like to own anything in a stage 4 bear market, because you lose money, and the times I've done that, the few times I've done that, I have lost money. In stage 3 topping market, when you're in a market like that, basically you don't make any money either. What you see are rallies up in which you do get some people excited about them, but no one's making any money. That's the situation we're in as I make this video in the U.S. stock market, and you tip into a horrible bear market. I think really we're in the very first inning of a bear market, but regardless, it doesn't matter. You may be watching this video 1 or 2 years from now. What is important is I like to own things that are in stage 2 bull markets or towards the end of stage 1, where I think the stage 2 upside is right ahead. So that's what I like to own. And I like to own funds spread out in things that are in that and diversify that way. And you can identify what stage you're in by looking at where the 200-day moving average is relative to the market you're looking at. The 200-day moving average, when you're in a bull market, it slopes up, acts as a support level. When you're in a bear market, it slopes down, acts as a resistance level, and in between phases, it tends to go sideways. Let's apply the concept to this, the golden ratio, which is another fascinating indicator. What you see right here is the price of gold divided by the S&P 500. Creates a relative. One thing it does is one simple way to think of this is how many S&P 500 shares does it take to buy a price of gold? Well, it takes more because at the moment the price of gold is like 1,200. Let's say 1220, 1240 or something, and the price of the stock market is above 2,000. The S&P is above 2,000. So, how much? It costs 60%, of an S&P 500 share to buy 1 ounce of gold. Let's say, and that's one way to think of it. So if you think of it that way, when gold made a top in 2011, it was costing. It was valued it cost 1.7 S&P 500 shares to buy an ounce of gold. Back in 2000, it cost 0.2. It's one way to say that gold was really expensive relative to the stock market in 2011, and in 2000 it was really cheap. This is also a relative strength ratio that tells you that when this is declining, it means the S&P 500 is also. It means that the price of gold is, when this is declining, the price of gold is performing worse than the S&P 500. When this is going up, it's performing better than the S&P 500. So let's apply our concept of stage analysis and figure out how we can use this to our advantage. So let's see. This was a stage 4 bear market for this chart because the moving averages were declining and acting as resistance. What that meant was, on this chart from 96 to about then in 1999, the price of gold was performing much worse than the U.S. stock market. That was the bubble bull years of the tech bubble. So that meant you'd be better off owning stocks than gold. And then we had a time from 1990 to 2001, which was a stage 1 basing phase, came after the bear phase, in which the relationship was essentially even for a little while. There was no huge advantage owning one or the other. But what was important was a bottom in this ratio was forming, which meant that in time this was going to change. And an epic trend change was going to happen where gold owners were going to be much better off than stock market players. And that began in 2001, and gold vastly outperformed the stock market from 2001 up until really 2009 and continued into 2011. So this was a bull market in which the moving average tended to act as a support level, but then we had a major sort of a manic peak in 2011. It formed a stage 3 top, and we decisively broke down, something that didn't happen in 2010, 2011. We went sideways with that sideways a couple other times, but this time we decisively broke down into a stage 4 bear market. So we had a time for a couple years which gold underperformed the stock market vastly, and it was a time when gold actually was in a bear market. The stock market went up. So remember, stocks, the bull cycles in the stock market and bear cycles in gold, sometimes they do happen that way. Sometimes they happen at the same time, sometimes they don't. They don't really always trade opposite or together one another. What's important is they kind of trade in their own world. But what's important to us now is that a major bottom in gold stocks occurred last year. A panic bottom, we'll go into that in a little later in module, but a major bottom formation formed from the summer of 2015 to January 2016. That was the stage 1 base. Sometimes stage 1 bases only take a few months. And now we've broken out of the high of that ratio last year, had a nice surge up. Usually in bull markets, you get fast surges up to start them out. That's what happened in 2001, in fact. And now we're above the moving averages. Those moving averages are starting to curl up just like they did in 2001. That means an emerging bull market in this ratio is forming. That means for the years to come, we can expect gold to outperform the U.S. stock market. That could mean the U.S. stock market's going to tumble really bad and gold's going to go sideways and act as a safe haven. I think it's going to go up, but it also could mean the stock market is just going to do nothing and gold's going to just break away from it and go up. That's the key, though, phrase right there, word, breakaway. Gold is now breaking away from the U.S. stock market. It's going up, and the stock market is dead money. But here's the psychology of gold right now, despite that, as I'm doing this slide, this video. Bull markets go through psychological phases for the investors that are in them. When they top out, people have a sense of euphoria. When a bear market, stage 4, starts, they do become anxious because they're no longer making any money. They think something might be wrong, but they stick with the game because most people don't know anything else to do. But you do, so you're not in that trap. But people will just get anxious. They experience more losses. They go into denial. But when a bear market bottom comes, many people capitulate, sell on the low, they get out forever. Others that hold in despondency, it's upsetting. And then even as the new bottom comes in the first rally, they still have these negative feelings and kind of feel depressed still from everything that's come the years before. Right now, that's where we are in gold, interestingly enough. There is no real excitement in the moment about gold. We're so early in the bull market. The masses have not got into gold. So that's where we are. And that really makes for the greatest time to invest in any market when others can't, because the people already in are just so shaken up by the losses before, and the people out there who have no involvement in the market, have no idea what's going on. They're all caught up at this moment, obsessed with the U.S. stock market or whatever. It takes gains, to more and more gains over time, to get more and more people into a market, more and more people in, and that's what makes the market go up. And eventually, so many people get in, there's no one left to get in. That's what makes the euphoric top. But hardly anyone new is getting into gold, so we're so early in the game as I do this video. And that makes the upside potential for the next couple of years tremendously exciting. So let's take a closer look at what's going on with gold right now. This is 2011, that stage 3 top formed for a couple of years. You can see how the moving averages flattened out. Stage 4 began in 2013. I think it was a definitive launch of stage 4 when we had a break of the 1500, which acted as support in 2012. In fact, we gapped down below it, and it was a total disaster for about 2 years. Gold fell all the way down to 1050. You can see the stage 1 base. One thing that happens in a stage 3, what I want to point out, is you get rallies, sharp rallies up and down as the base forms, but the rallies up, they excite people, they make people think, oh, more gains are coming, but then the market will stall out and come back down. And it can do that multiple times over and over again. That's a sign that you're in a topping market. When you get rallies, but they don't lead to new highs and beyond, so no one's making any real money. And they're just spinning their wheels. That's what's actually going on in the U.S. stock market right now. But stage 4 is where you see the 200-day moving average is acted as resistance. Now, stage 1, an interesting thing that happens in stage 1 is you get breakdowns in price that scare people because they've seen so many drops, from the bear market. But instead of leading to giant drops, the breakdowns just lead to bottoms real quick as they don't go anywhere. That's a sign, kind of the flip of stage 3. When you had breakouts that lead nowhere, now you get breakdowns that don't lead to big selling. Instead, it's basing that's going on. So that's what gold did from July to really January this year. We broke out, had a tremendous rally, and now it's broken away from the moving averages, and the moving averages are now going to begin to act as support this year. It may be a while before we even touch the moving averages again. As I do this video, gold appears to be in a short-term pause consolidation phase. Remember, people are depressed because of all the losses before. Really, they're not sure what to think. You know, they've been fooled so many times. They don't want to be fooled again. So what that means is, if once gold breaks through, let's say 1,300, we will move from the depression phase to the hope phase. And people will begin to finally start to get excited about gold. But we're not even at that point yet. So, and then once the bull market happens, you go to optimism, excitement, thrill, euphoria. The whole cycle typically lasts 3 to 5 years. Conclusion: how to profit from gold. Well, I've just given you a good overview of thinking about gold as an asset class. I don't want you to think of gold as an insurance policy, and I want you to get away from the TV talk that gold is toxic because it doesn't pay dividends, or you can only own stocks. All that's garbage. I'm not going to even bring it up anymore. So now in the next videos, we're going to still talk about more about gold, its relationship to other markets, but the whole point of all these modules, when you put them all together, is how to profit from gold. And you can profit as a well-diversified investor, which I do, and we'll show you through the model ETF rebalancing system. You can profit from simple swings in gold by playing the trades up and down. I'm going to talk about that. You can also profit from exchange traded funds, sometimes ultra funds. We'll talk about that. And we're going to talk about mining stocks, where there's real juice to play gold, because mining stocks are more volatile than gold. They go up more than gold does in gold bull markets. I own mining stocks, and I think the potential to make money in them right now over the next couple of years is very exciting. And I'm going to also show you in these modules how to do stuff no one talks about, and that is how to invest like an insider in the gold industry, in mining stocks, not just to simply buy them on the stock exchange or like a typical stock, but to how to get into pre-IPOs, private placements, and all these other kind of opportunities that most people have no clue about, but they're out there, and that's where huge fortunes can be made when things pay off. So this is going to be exciting times in this module, and the rest to come are going to be your arsenal for these coming years.